Have you been following the banks collapsing? Are you worried about banks collapsing? Well, what about insurance companies? What about your insurance policy? What about your infinite banking policy? Can those financial institutions collapse? We're going to break it down today. Hi, everyone. Welcome to Control and Compound with Darren Mitchell. I'm your host, and joining me as always, Christina Wyatt. Christina, how are you today?
Hey Darren, I am doing awesome. How are you doing today?
I'm doing great. Excited to get going. But before we do, you want to say anything?
Yep, I just want to remind everybody that if you're listening on your favorite podcast platform, you're going to want to subscribe and leave that 5-star review. And if you're listening or watching on YouTube, please make sure you like, subscribe, and hit the bell button so you always know when new content's coming out. And don't forget to follow us on our socials at Control and Compound on Instagram and TikTok.
Okay. Thank you. So we saw SVB Bank collapse in the States, and a couple others followed, and people are worried about the banking industry. We had a lot of calls from people saying, "Oh, what about my whole life? What about XYZ company? Could they go under?" So we thought this episode we'd kind of break it down and just try to let people know what you should be concerned about and what you shouldn't be concerned about. So we're kind of going to break it down in a couple sections here about different layers of protection. But I think the first place to start is really the contract itself and the insurance professionals you're dealing with. So if we get into the contract, Christina, what I love about, again, we're talking about the contracts that we're going to use for infinite banking policies. We're not talking about every insurance contract in the world. We're talking about our specific contracts of what CNC or Control and Compound does. So the participating whole life companies that we deal with all are the exact same in the sense that the contract is unilateral and binding. So what does that mean? That means unilateral, it can only be changed by one person, and that's you. Okay? So if you're the policyholder, the insurance company can't say, we thought about it, we'd like to change the contract. We don't want to loan you 90% of the cash value. We don't want to pay a death benefit. They can't make any changes whatsoever. It's contractual and it's binding. Okay? Now there's all kinds of guarantees built into these contracts. And again, the insurance company can't change it. They can't update it. They can't modify it. There's guarantees on the death benefit saying no matter what happens, you're going to get this death benefit guarantee. There's guarantees on the cash value to say no matter what happens, you're going to get this cash value guarantee. That's even if there's never a dividend paid. And they've never not paid a dividend ever. So again, built-in guarantees in the contract. The other big one is once a dividend is declared, it's yours to keep. So if you go up to $120,000 of cash value, you can't go down below $120,000 next year. That's your floor now. You can't go down. As opposed to the stock market, it's like, woohoo, I'm up to 120. Well, you could be 60 or 70 grand the next year. So again, once we get that floor, that's protected. And then the final one, and Christina, if this is set up properly, but you can also have creditor protection. And I'll let you talk a little bit about more of that when we get into the last part about dealing with the right advisor. So, those are contractual guarantees that are built in for all of our customers to help give them that level of protection.
Yeah, no, we've got lots of great guarantees there. So, that's part of the contract. It's written in the contract. It has to be done. So we've got the guarantees built in the contract, but as you mentioned, it's very important to work with someone that specializes in infinite banking when setting these up. Because in order to get the other guarantees and for things to work correctly and have those guarantees, you need to be working with someone that knows what they're doing. These can be set up incorrectly, and they are all the time, right? We see it all the time. So make sure when you're setting it up, work with an individual, an infinite banking practitioner, someone at CNC makes sense. But make sure that you're working with a specialist that knows what they're doing. And by working with a specialist, the first one that you said is that creditor protection. So when these are owned personally, we can have full creditor protection in place. Like you go bankrupt, you get sued, these cannot be touched. You have to have a family member named as the beneficiary, but a specialist is going to make sure that that's what you do. So that, and you don't have to do that, right? Like the insurance company is not going to say, hey, you set this up incorrectly. you're no longer creditor protected, they're going to allow you to do it. It's up to you to make sure that you're working with someone that's going to set it up right. So that's the first one with the beneficiaries and getting that creditor protection. Another one is maximizing cash values. So when we set up these policies, we are always setting them up to be as cash value as efficient as possible. They don't have to be set up this way. It's how we have to set them up for infinite banking, but it's not necessary. The insurance company, again, is not going to come back and say, hey, you didn't set this up right for infinite banking. You're doing it wrong. You have to make sure you're working with someone that can do that for you. And when we maximize those cash values, we bring in a whole lot more guarantees because now that cash is building quickly. And we have cash in there that we can use through those contractual loans, the 90% cash value that they're going to allow you to loan at any given time. Well, when you have a lot more cash in there, you have a lot more money that you can loan. That's important. Another one, we never see this happen. And if they're built correctly, it doesn't. But at any point in time, your cash value is your cancellation value. So if you were to have to cancel this policy, you're going to receive your full cash value back. And when these are set up correctly, that full cash value is going to be in the first couple of years, maybe a little bit less than what you've put in. But a few years in, it should be exactly what you've put in there, right? Like you shouldn't be losing money. It's going to be more eventually, but within a few years, you're going to be more than what you've put in there and you're going to receive that back. That's a nice guarantee to know that, what's my worst case scenario? Well, I get my money back. It's written in the contract. They have to give you those cash values back. And when set up properly, those cash values are going to be large and they're going to be, it's going to be a nice guarantee to have built in there inside of the contract.
Yeah, because you can set up a contract with, not maximizing cash value, and great, I can cancel and get my cash value. But if your cash value is $12 and you put in $100,000, who cares that it's guaranteed at $12? You've got to make sure it's designed properly to maximize that cash. But what happens if the company you're dealing with or the advisor you deal with? What if that advisor goes bankrupt or control and compound goes bankrupt? Like, what kind of protections in it for the policyholder then?
Yeah, that's a very valid question, right? When you're setting up one of these policies, what happens if you're not around? What happens if we're not around? Well, your policy is not held with the company, so with Control and Compound, with the advisor that you're working with. It's held with that insurance company. So if you have a policy with Manulife, your policy is with Manulife. You can call, and you can call Manulife directly or Sun Life directly and ask them for information on your policy. You're just as much their client as you are ours at the end of the day. Now, I don't know, you won't have as good customer service calling them, so I don't recommend it. Definitely come to us first. But your policy is held directly with them. So if something happened to the advisor, something happened to CNC, the insurance company is just going to take care of the client. Sometimes they'll pass them on to a new advisor that's able, or you can go pick your own advisor, right? You can switch advisors as well. So your contract is with the insurance company. It's not with the advisor or the company, the advisor's company that you're working with.
Okay, great. So that's awesome. So that's like awesome levels of protection just within the contract, within the companies we deal with, added layer of protection when you deal with people that know what they're doing, specialize in this cash value life insurance stuff. So that's the contract and the insurance expertise. Let's go up the next level. And Christina, let's talk about the insurance companies we deal with. And the insurance companies we deal with, what kind of levels of protection do we have there?
Yeah. So first thing I want to say is that we're very particular about the companies that we work with when we're setting up these infinite banking policies, right? We have rules. We want these companies to be around 100 years plus. We want them to have billion-dollar participating funds. So we're not working with just any company when we're setting these up for our clients. We're working with the 4 big major companies that offer these policies. And those 4 major companies last year, we talked about it in our industry update just recently, they made between $3 to $7 billion of profit. So, Manulife, Sun Life, Canada Life, Equitable, these are big insurance companies. We're not talking a little company, a little business. They've been around for hundreds of years, as long as Canada's been around in some cases. With some of them, they're large, very, historically sound companies. Another thing to keep in mind with this, though, is that the participating fund, so where all of your funds are held, where the policyholders own that fund, that is not lumped into, their overall surplus. It is separate. It has to be, it's federally regulated. It has to be held separate. So all of those assets are held in a separate fund from the regular business activities. So that's another layer of protection right there, right? You're not lumped in with Sun Life. You're not lumped in with Manulife. You are the policyholder. You are the owner of that participating fund, right? So if these companies were to go bankrupt, your fund is a separate entity over here, right? It's not going bankrupt with them. It's on its own, in its own world on the other side. Separate, right? Very separate.
It's like a line in the sand, right? I mean, on one side, they have all the other operations of the insurance company, and on the right side of the sand, they have the participating whole life. So again, no insurance company like the ones we deal with, we think is going to go bankrupt. But in theory, Manu Sun, they could go bankrupt, and your participating whole life policy is completely protected because that's not an asset of the insurance company. That fund's owned by the policyholders, and you're a policyholder. So, incredible protection there. And really, when we talk about the insurance industry in Canada, the insurance industry is as old as Canada. It's actually a little bit older. Basically, since Canada has been around, we've had insurance companies been around. And what do insurance companies do? They manage risk. So if you're worried about risk and things collapsing, I think dealing with companies that since the birth of Canada have been managing risk and got really good at it, and you can tell from the track record, the track record of the companies we deal with, no one's ever lost money. They've ever not paid a dividend. There hasn't been a participating whole life policyholder that ever didn't get 100% of their value in the history of Canada. So, incredible history on these companies, and it's what they do. They manage risk. So again, that's kind of the company level, which was really the next level. Anything else on the company, Christina, before we go to the next level of protection?
Yeah, I just wanted to how they manage this, at the insurance companies, there's actuaries. So there are these people that spend their lives analyzing risk. They analyze risk day in and day out. They look at lapses. They look at deaths. They look at insurance premiums. And they've been doing this for hundreds of years. They have hundreds of years of data that they're sitting there and they're analyzing to decide what reserves we need to hold to be able to pay out those death benefits. What would happen if, everybody died tomorrow? Do we have that on hand? This is what they do day in and day out. And like you said, they've been doing it it's very, very, very long time. If you want to have your money somewhere where there's a calculated outcome versus a volatile outcome, this is calculated. It's a very calculated way to do it. Some years they have to increase insurance premiums to make sure that they're not on policies that are in place, but future policies, if they're finding things are getting off balance, you're going to go see increases in pricing that's done for them. And they're looking at this every single year as a whole, and they're deciding, and this is all they do. This is what they look at, and this is what they do best. That is, that's pretty important. It's a pretty important fact to share that these insurance companies, that's how they're analyzing this, right?
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
Yeah, I mean, they're specialists at risks. And I mean, you think some of the strategies, you think it's just random products they sell, but there's a method to the madness. So, insurance companies are big on annuities, and annuities where you trade a bag of money for a payout for the rest of your life. Well, what is that? That is the opposite risk of life insurance. Now, again, I'm not saying people in the head office of insurance companies are thinking this, but if you have an annuity, the insurance company wins if you die early because, oh, great, we'll pay you 50 grand a year for the rest of your life. Well, you live to be 125. They're not making money on that. You live 2 years, they made a boatload of money. Well, life insurance is the exact opposite. So in the insurance company, when you buy a life insurance contract, they hope you live forever. Because if you die after a couple of years, well, you only paid a little bit of premium and you got this huge death benefit. Well, that annuity and the life insurance are on separate sides of the life expectancy. So if the insurance companies people start dying earlier, well, life insurance might not be as profitable, but the annuities be way more profitable, and vice versa. And I mean, there's a million different things the actuaries do. I mean, when they're not on the weekend having crazy parties, those actuaries, but million things they can do. I've actually partied with actuaries. There's some really great ones out there. So that was just a little joke for my actuary friends. Okay, so we got the contract as a guarantee. We got the design with a qualified specialist like us that deals with that. Then we've got the company guarantees with all the things the companies do, the track record, the history, the experts at managing risk. Now we're going to go up one more level of protection, and we're going to talk about oversight, reserves, and regulations. So again, in Canada, we're blessed to have an incredibly healthy insurance industry. It is heavily federally regulated. Some countries it's like, we promise we're going to pay. We're going to pay if you die, for sure. Well, in Canada, it's not like that at all. It's heavily federally regulated. They have reserves they have to set up. So in the Canadian marketplace, we have what we call OFSI. And OFSI stands for the Office of the Superintendent of Financial Institutions. Okay, this is a government agency that manages financial institutions. And then under that, they have the Insurance Act. So we've got OFSI. What does OFSI do, Christina?
So OFSI regulates and reviews. They'll come into these insurance companies and they'll make sure that they are extremely well capitalized and that they can stay afloat. So they're measuring, they're reviewing, and they're making sure that these, they've got those reserves in place for the policies and the products that they have. So it's not, there are regulators coming into these insurance companies regularly, and they're getting audited regularly to make sure that the products that they're selling are, they're funded, they're properly backed, and they have tests and they have measures to do this, and they're due every year, and it's all published too. Like this is not, this is out. Anybody can look these up and check it out and make sure that these insurance companies are being regulated, and they are. So, but I'll let you kind of go into the way that they measure and how they, check out the surplus requirements.
Yeah, well, just before we even get into that, like these stress tests are like amazing. Like it's like, oh, what happens if the stock market dropped 90%, or what happens if we go to a long recession? What if people start dying younger? Like they run all these scenarios, and still, regardless of what they do, that they make sure you're financially sound. I mean, it's my brother's a commercial airline pilot, and it's like he tells me when he goes to the simulator. So, well, when you go in the simulator, what do? Well, they throw everything at you at once. It's like, oh, the right engine went, the left engine hit. Now you get hit by lightning. Now you get a passenger with, whatever problems. And now the wheels don't come down. They throw like a million things at you, and then you see if you can still land that plane successfully in the simulator. Well, it's the same thing. OFSI comes in and goes, oh yeah, well, what if this happened? What if that happened? What if that happened? And the insurance companies need to have the capital reserves there to say, yeah, we'll be okay if that happens, and they got to prove it. So again, huge advantage of dealing with in the Canadian industry what we have, and these surplus requirements that they're required to have. Now again, they always try to make fancy letters. We got OFSI. We used to have MCCSR, which is called the Minimum Continuing Capital and Surplus Requirement. Basically, do you get enough money on hand to stay afloat no matter what happens, is what they're looking for. But that was a little too hard to remember, so in 2018 they changed it to the LICAT, LICAT. Apparently that's way easier than MCCSR. But the LICAT kind of came up, and they go, okay, let's find out how much capital you need divided by how much liabilities and how much assets and stuff. And they go, we're going to come up with a ratio, and the ratio is, when we run it through this stress test and all these different scenarios, at the end of the day, we want you to have a 100% LICAT, which basically says no matter what happens in all these variations, there's enough money in there to pay it. So every insurance company in Canada has to have a LICAT of at least 100%. Now, including the stress test, right? So when we look at the companies we deal with, not only do they all have that 100%, which means they're financially stable to handle all those stress test things they threw at them, but they bumped it up to not just 110, not just 120, but they're at 130, 140, and 150% of what the requirement is on top of all those stress test analysis. So we've got an incredible multiple layer of protection with this oversight, with the reserves actually being checked and maintained to say you have to have those reserves in. And then finally on the insurance companies, unlike the banks, what do the banks do? The banks create money out of thin air, right? You go in to get a loan, and how do they create money for that loan? Someone grabs a keyboard and says, okay, we're going to loan you $100,000. It artificially, or it increases the money supply. It's like printing more money. Insurance companies, we don't do that, okay? We don't do that. When you borrow from an insurance company, it's backed dollar for dollar. They're not creating that money out of thin air. So if you borrow $100,000 from your cash value life insurance policy, it's backed by $100,000 in assets. It wasn't just someone at the bank creating money. It is backed dollar for dollar. So we call that sound money. So again, much different than a bank, much better regulated than the bank for we think for.
I want to make one more point here too, because we're talking about testing and tests and what ifs. Well, these companies have been around through all the what ifs. Let's just remember, like, they paid a dividend in World War I, in World War II, Great Depression, 2008 market collapse, pandemic last year. And, it's not just a test. They've been tested. Like, they've been around a very, very long time. They've passed the test in theory and in real life. In reality and in theory, they have passed these tests because we've seen it. And that's why we like that historical data, right? That's why we like using these companies that have been around a very long time. They're not just tested. They have passed these tests with flying colors throughout all of these, economic changes and life events and world life events. They've been through it all already, and they've taken everything that they've thrown at them, and they've paid a dividend to our policyholders. So that's pretty nice to see.
That's a great point, Christina. So we get amazing oversight, we get amazing history of these companies, strong, stable companies. We get the great contracts, we get the great advisors that are helping you. And then we're going to put another layer of protection on there, and we're going to talk about Assurus. Now, Assurus is spelled Assuris, Assurus Protection. Christina, what's Assurus, and why is it such a great thing that we have it?
So Assurus is actually the insurance company for insurance companies. Can you imagine an insurance company having its own insurance company? Yep, they do, because this is what they do. They manage and they mitigate risk. So of course they're going to have their own insurance company. Assurus is a non-for-profit insurance company that actually goes out and they collect the premiums from its members. Now, you don't get to decide if you're a member. If you want to be a life insurance company in Canada, you are a member. So you have to be a part of this, and they can collect unlimited funds. So whatever they need on hand from these insurance companies to make sure that if something happens to to them, if they were to go bankrupt or they just insolvent, they're going to have that cash on hand for their clients and to be able to fund those policies, right? So the Assurus, they go out, they collect these premiums, and then they have enough cash on hand to meet the immediate needs of a fallen insurance company. So they are, exactly what I said. They're the insurance company for insurance companies.
So the insurance companies all pool a bunch of money into a kitty and say, great, we're going to have this big reserve, and Assurus is going to maintain and look after it. And if any one of us go under, we've got the funds on hand to make the policyholders right, or to look after that company when it's going under. They have, and they can raise unlimited funds. So if, in other words, if a company ever did go bankrupt, they can go in and say, we need X amount of money from every insurance company to protect these policyholders. Because again, you think of it, Canada, people don't lose that invest with insurance contracts for bankruptcy, and the insurance industry wants to maintain that. So they're willing to throw a bunch of money in every year to say, great, let's build up this big pot. And then
it also doesn't typically get there either, because they have the ability to port these contracts to another insurance company. So if an insurance company was on the way, and anytime I've ever seen it, they're getting purchased. So we're not even seeing it get this far. Somebody else is purchasing this insurance company, and it's getting bought by the other the bigger guys. You're seeing the bigger companies buy out these smaller companies. They're not actually going bankrupt or out of business. Now, if that happened, the first thing Assurus does is it just ports the policies to the other company. So your par fund is literally just going to move to the new company. That's what's going to happen. It's going to easily go to the next one. So you're not really seeing it hit the worst case scenario at the end of the day, which we're going to talk about.
It's not going to happen, but your insurance company could go bankrupt. Your whole life fund would be protected because it's separate and segregated, and it would be ported over to a new company, and that new company would have to honor your contract because it's a unilateral contract. Okay, and then Assurus, again, within Assurus, on top of all that, they have actual dollar amounts that they're gonna physically guarantee. Okay, and like for the death benefit, if the minimum 100% of the first $200,000 they're going to guarantee. Health insurance $60,000. If you have a monthly income product, $2,000 a month. Cash value life insurance $60,000. And again, it's never happened. It gets ported over to the other carrier, and you get 100%. But then the other kind of huge kicker on this, which is really going to separate us from the banking industry, is those guarantees I just talked about. It's that or 85% of 85% of what you had. So if you had $5 million in a participating whole life contract and you went bankrupt, well, I would have cashed it out the day before. I don't think a company's going to go bankrupt, and if they did, it should be ported to the new contract and it'll be 100% whole. But let's say every safeguard in the world failed, everything failed. 85% of that is going to be guaranteed. If you had $5 million in the bank, how much of that $5 million would be guaranteed if the bank went under? Christina, what's the number?
100,000. CDIC guarantees 100,000. That's scary because there's business owners out there with that amount of money in their corporate bank accounts as retained earnings, and this is where they believe it is the safest place to be. But 100,000 is peanuts compared to 85% of what's actually in there, right?
Yeah. So again, unbelievable protection. And again, if you think of it, no participating whole life policyholder in the history of Canada has ever lost money because of a bankruptcy in an insurance company. So if they get in trouble, they get sold. If not, they get all these levels of protection. So we don't get there. We get the portable contract. We get the unilateral contract. I don't believe there's a safer place in the world you can be parking your money than some of these Canadian insurance companies. And it's not just me that thinks that. Look at the money that pours into that. Look at the stock prices of these companies. Look at the assets they have. Look how they've been able to gather assets. If you want your money protected, you should look at putting a portion or a large portion of it in a strong, stable company like an insurance company, ideally in a participating whole life contract.
And use the specialist. Make sure that you're working with someone that knows what they're doing. But yes, there is no safe, you have to put your money somewhere. And when you start seeing these banking collapse, the news articles and news stories coming up and stuff, you start to get worried. And there are places that can take away that worry. Like you and I both sleep very well at night, Darren. We're not concerned. We're doing very well.
I think of my participating whole life contract as a force field around my financial affairs. So what that does is no matter what you throw at me, I'm going to be fine. Market crash, I'm fine. I'm uncorrelated to the market. You're going to increase taxes, I'm fine. You're going to sue me, I have creditor protection. You start going through that list, and there's all kinds of them we can go through. And the next one is, what about a banking collapse? What about an insurance company collapse? Again, I've got that certainty, that force field around my financial affairs. So if you want safety, if you want certainty in an uncertain time, participating whole life. Thanks for watching. Thanks for listening. Have a wonderful day.
Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.